All right, this is the final pre-CPI analysis, if you want to call it that, of the futures markets and equities. This is going to be an epic event tomorrow. The last two instances were a huge gift for the bulls. Those were the anchor points for the entire 2-month rally we've been enduring. And the bulls seem, for the first time, convinced they're going to be a three-peat, because unlike the last two times, they gobbled up equities prior to the report. Here's the ES over the past week. Early last week, we got a nice descent, which ended on Wednesday. That's been the low for quite some time. And it unwound part of that, but then when the PPI came out on Friday morning, that zapped it. And we closed pretty near the lows. And then for reasons that I'm not sure of, but I suppose relate to the fact that people want to get in before the CPI, that was all unwound. So we actually wound up higher on Monday than we were pre-PPI. It's like the PPI didn't matter at all. So that's where that's at. This is on a 5-minute chart. If we go to, say, a 30-minute, you can see the first important line limit up here, which is the now broken intermediate term trend line. And so as we look here, this was the early summer bottom, which was part of that horrid 615 to 815 rally, which lasted 2 months. And this is the latest base, which just so happens to be almost 2 months old. I had really thought after this one, the notion of a 2-month counter trend rally was gone. How wrong I was. That's exactly what we've endured. Interestingly, this most recent rally presently doesn't look as in good shape as this one did. This one just kind of just kept rocketing higher. This has been much more muted. So what the bulls want to see, of course, is a launch above this line, and what they really want to see is not only pushing past this line, but even this line. And that would be this would be bad, and this would be horrible for the bears. What the bears want to see is a failure of this line. And so in very simple terms here, a failure of about 39.46. And this is the future contract changed, so that's why the numbers are suddenly different. It used to be 3,900, but now it's 39.46. And for the bulls, they would want to push past basically this high, that they enjoyed back on the beginning of December. And this is the range we're in right now. So that's kind of where it's at on that. If we look at it daily, you can see the entirety of the bear market, and you can see this base and this base, and we're kind of like, this teeny little congestion area. The bulls expect it to resolve to the upside. But as we've quite plainly seen, the short-term moves don't necessarily constitute what the rest of the day will hold. So I'll be, on pins and needles at 5:29 and 59 seconds tomorrow morning. But the initial move isn't necessarily the move for the day. And in recent times, it seems that downward moves don't stick, whereas upward moves do. So the bears are at a disadvantage there. Having said that, if it pops higher and then starts falling, that would probably be the best possible news for the bears of all. That's kind of what I had to say, but let me just peek at the other markets to see if there's anything worth sharing there. The NQ's kind of wound up too, but if we look at this, say, with a 4-hour bar, and I've mentioned this before, this was the base, and then we've got this weird second pattern going on here, which is range bound. So the escape from the space has been really rendered irrelevant because we've bounced within it, without it, within it, without it, within it. And it's more about this range right here, which probably is better to see, yeah, on a 1 hour chart. So for a few weeks now, we've been just sort of ambling through this enormous thing. And probably the least important of these is the RTY, but this is a bit of the same idea, and this has been the weakest of them. As you can see, it's slipped even below its range here. Last item, as far as the bonds go, this is the 4 hour bars, and you can see for weeks now it's been this kind of gently ascending pattern. It isn't quite as easy a read as the stocks, but what is pretty easy to read about it is what's been going on over the course of the year, because we can track the downtrend just like with equities. And this isn't quite as fluid as my beloved slope charts, but yeah, so you can see here how not only has it been in a downtrend, but the most recent high hasn't even managed to tag that line. Maybe it will tomorrow. You know, could happen. Okay, well, I am mildly nervous about Tuesday morning. Based on that, I did lighten up somewhat. I've got a little over 15% cash and 25 positions. So if by some miracle things are clearly going the bear's way, I will kind of ramp up the aggressiveness again. But until then, get kind of holding back, because the last 2 instances were just so brutally awful. Really rather not have a third awfulness happen. So good luck to you.